Hello everybody, welcome into the NinjaTrader Ecosystem webinar room. Before we get started with today's presentation, I'd like to take a moment to test for picture and sound. So if you can hear my voice, and if you can see the screen showing Bubba on the screen, type in the letter Y, and this will confirm that you can hear my voice and you can see the slideshow. Alright, thank you all for confirming that. I'm coming in loud and clear. And thank you all for joining us today. My name is Ryan Lai, and I work here in the Denver, Colorado office at the NinjaTrader Business Development Team. And we have a very special event for you today with Todd Horwitz of Bubba Trading. Before we get started and move any further, I do have a quick question for everybody in the room, and it's a simple question. It says, are you currently using NinjaTrader? I'll put the poll in with the type of user that you are for NinjaTrader, and while you're filling out this poll, it'll give me a chance to go over a required disclosure here. All right, so while we've filled this out, I'd like to remind everybody in the room that there are substantial risks in trading commodity futures contracts, and you should carefully consider whether such trading is going to be suitable for you, and this will depend on your own specific circumstances and financial resources. It is possible to lose all of the funds that you deposit with your broker, and you can even incur losses beyond these amounts. If you have questions, you can always inquire to our risk disclosure. I'm posting it in the room here. You can get more information by looking at our risk disclosure, and you can also request to receive a CFTC full risk disclosure. Also, please remember that these training webinars are not solicitations for any services, nor recommendations, but they're simply educational in nature. And then also, this presentation is being presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. If you have brokerage-related questions, please send them directly to the NinjaTrader brokerage. And I'll post the information into the room here for that. You can send it to brokerage@ninjatrader.com, or you can call the number 312-262-1289. All right, and it looks like everybody had a chance to fill out the questions. It looks like the people in the lead in today's presentation are people currently not yet using NinjaTrader. So it is great to see people that are interested in NinjaTrader as well as the vendors that we have in our ecosystem. If you haven't currently downloaded NinjaTrader, I want to give you a chance to download it at your convenience at the following link. And you can also purchase or lease a live license key for NinjaTrader at your convenience from the following link. All right, so with that being said, we are very excited for this unique event today with Todd Horwitz. He shares his unique methods for reading the footprints that markets leave on the charts. So without any further ado, I wanted to thank your attendance today, and without any sort of further ado, it's my pleasure to welcome into the webinar room Todd Horwitz. Go ahead and take it away, Todd.
Thanks, Ryan. Great to be here, and always fun to be involved with NinjaTrader. It's a great platform, and we like doing business with you guys. It's great to be here, everybody, and welcome. And as I open up all my calls, what's up? And what's up, everybody? Of course, well, the markets are up again today. That's for sure. They may never, ever go down again, but we're here and ready to rock and roll. And, of course, I also have to do a disclosure for you as well. So trading involves risk. Past performance is not indicative of future results. And you can read the others while I'm talking, and I'll leave this up for a few seconds, and you can look. But in the meantime, again, the markets continue to go up, and they continue to dribble up on pretty much light volume and light action. But it really doesn't matter, especially with what we're going to share with you today. And again, it is great to be here, and I appreciate everybody here taking the time to spend some time with me. In the meantime, I am, for those of you who don't know me, Todd Bubba Horwitz. I've been doing this for actually 38 years. I started out at the CBOE, and I'm still currently a member of the Chicago Board of Trade. I was one of the original 3 market makers in the SPX pit, which is now obviously the biggest pit on the options exchange, and everybody uses the ARB against futures. I am the founder and chief strategist of Bubba Trading, and I've written a couple of books on option trading. I regularly contribute to Fox, CNBC, Bloomberg, BNN, RFD TV, and Phoenix TV of China, as well as Kitco News. And I have my own radio show every day at 2 to 3 Eastern on LibertyTalk.fm. So again, great to be here, and glad we could share some time together. Some things I do also is I do a lot of stuff for the CME as well in their futures department, and helping them get their information out. And we always find that to be interesting and helpful to let people understand, because many don't understand how the markets actually work. Today, we're going to talk about the skill of trading. All right, we're going to talk a little bit about what futures are, why I believe that futures are the best, the big advantage that you get, products, and then we're going to look at some charts and some indices and kind of break down the things that we look for and what makes it easily done as a part-time day trader. You know, I'm not a big, although I am a full-time trader, I'm not a huge advocate of full-time trading. I think that, you know, there's a lot better ways to do it, and we try to explain and teach that so that you can trade at your convenience when you're ready, instead of having to be stuck next to the machine all the time. Now, we talk about games of skill, and I think there's a lot of us, you know, some of you may play poker, some of you may play gin, some of you may play bridge, some of you may play backgammon. Those are 4 games that are all skill-based. In other words, if you can grind out the probability and put yourself in the right spot, you're going to be the favorite, and over time, you will grind out. The markets are the exact same thing. They are a mathematical game. And you know, even if you have, for the poker players, even if you have pocket rockets, it doesn't mean you're going to win every time. But if you get them every hand, you're going to win a lot. And that's what we're trying to do with what we do, is to put ourselves in a position to hold pocket rockets all the time. And it's easy to do, again, but you have to trust the probability of what we're doing. We're not looking for long-term trends. We're not looking to be, you know, in the market for weeks or months. We're looking at stuff on a very short time frame. That's how we allow ourselves to be able to trade on a part-time basis, because we wait for certain things to occur, and when they do, we're ready to rock and roll. So remember, this is not, it doesn't take a master's degree for this. It doesn't take a Harvard education. It takes the willingness to understand the charts and the markets behind that and how they work. And you get that, you can develop the skill as well as anybody. It doesn't matter who you are. Now, futures themselves, all right, it's a financial obligation. They're similar to options, okay, except that there's not strike prices. You're trading the actual future. You're trading, you know, whether you're trading the S&P, whether you're trading the Dow, NASDAQ, Russell, or you're trading in the grain space or livestock, wherever you're trading. It doesn't really matter, because at the end, from our perspective, all markets are the same. All charts are the same, all patterns repeat. So we don't really care what we're trading. Now, we look at certain things, and as we learn to trade, we try to trade smaller products that have less tick size and smaller movement, just to get used to and accustomed to what we're looking for. But once you're comfortable, then all products are the same, and it doesn't really matter. Now, when you have a futures contract, a contractual agreement generally made on the trading floor of a futures exchange to buy or sell a particular commodity or financial instrument at a predetermined price in the future. Now, again, most futures are used, of course, in hedging, but of course, they found out that futures were so good for hedging that they brought in speculators, and it's interesting if you just look at the history of the Board of Trade, which was the first true futures exchange. You had the farmers, and they go, what was a hedging exchange? But the fact of the matter is that they needed a speculator on the other side. Otherwise, there wasn't a hedge. You know, farmers aren't hedging against each other, so you always needed speculators, and that's one of the fallacies of the market. But futures trading is the best for a number of reasons. First of all, there is no premium in futures. Unlike options, you're not giving up an edge. You know, you're trading within. If you're trading in a liquid market, which is very important, you're giving up maybe a tick here and there, but that's no big deal. Okay, you're not paying a massive premium to get involved. You're not affected or worried about time decay. You're simply trading the absolute cash value or the market value at that particular time. The only things that can go wrong is if you're on the wrong side of the trade. If you're on the right side of the trade, you can't get time to get out. A lot of things can't happen. All right. There's no restrictions on short selling. All right. You know, in the stock market, you have to worry about short selling stocks. They're not always tradable. They're not always, sometimes they call it hard to borrow is the words they like to use. There is no hard to borrow futures. You buy them or sell them. That's all you have to worry about. The pattern day trading rule is a real tough rule to get around unless you have, a lot of money in your account. In futures, you can trade with $5,000 and control at any one time a couple of $100,000 worth of futures, all right? Because you're not subject to the day trading rules. You make a trade, you're on, your margin's in, you get out of the trade goes off. There is no 3 days to carry, or what they call Reg T, 3 days, T+3. You simply trade in and out, and when you're done, margin's gone, there's no carry, there's no number of trades, there's no pattern day trading rule, all that stuff goes away, right? And of course, you've got a good broker like Ninja, you get reasonable day trading margin rates, and that brings you into a spot that you can now trade with a small account with little risk. Now there's always risk, but we show you how to minimize that risk. But what happens is you allow yourself to get in and out of a market when you have the time, when you're ready, and you don't have anything else to worry about. We're not worried about some announcement. We're not worried about, what happens overnight. We're trading on a very short time frame, and we're looking for very specific things to happen. Now, in futures, you've got extremely efficient markets. That's, one of the things that I always worry about when people trade, there's Forex, there's forward markets, there's over the counter. I always worry about the ability to get my money out if something goes wrong. All right. And that's one of the things that I'd love to be in a licensed exchange that run very efficient markets. And what you'll find out is that if you're trading in a liquid product like the mini S&P or the mini Dow or any of the grain products, basically, as long as they're liquid, there's efficiency and they're regulated. Which only that means is that if some trader blows out one day or some firm blows out, your funds are guaranteed by the exchange. The exchange is basically just a clearinghouse that holds the money on both sides, which is why they charge margin. So you put yourself in a great position, and you don't have to worry about, for example, a couple of years ago when the Swiss franc blew out, those who were trading with unregulated exchanges lost all their money because the brokerage firms went out of business. Right? Even when EDF and MAN went out a number of years ago, all the traders got their money back. Basically, you've got virtually 24-hour trading. Now there's a little hedge with that, and that is the markets are not always liquid 24 hours a day. They're generally liquid between 9:30 and 4:15 Eastern time. However, if there's something going on in the market, or there's something going on, overseas, they can become liquid. Now, I always use the example for when Brexit happened, I traded for 36 hours straight, and it was swamped for 36 hours. I mean, so there are times, but again, I don't want anybody to get them in the middle of the night just because they have to trade. What I'm telling you is that there'll be times that you might have the opportunity to trade at night or late in the afternoon or early evening. But also some people that don't live here, that maybe they like to trade the DAX or they like to trade the FTSE or whatever it is they want to trade. Those markets are all available to you through futures, and of course they're all done electronically. And within, I'd say, another year or so, there'll be no more pit trading. It'll all be over the screen. So I think that's something that's important to understand. Now, there's no interest charges. There's no pattern day trading rule. Liquidity. Again, you've looked at many stocks, and typically, it's not necessarily as liquid. These are always liquid, right? And you can diversify if you choose. And there's a whole mess of different trades that you can make. We're going to focus on one specific model because that's the day trading method that I like to do. But overall, you can do, there's a lot of different strategies depending on what you're trying to do. I mean, I occasionally will spread one future against another. That works also as well, but that's not what we're working on here, and that takes more capital to do that. But again, you can diversify and you get the direct correlation. So the underlying asset that you're buying the future or selling the future on, you're going to get that direct correlation. There isn't an oops, by the way. It's straight up. It is or it isn't. Markets move. That's what we get. Right? So that's the focus that we want to make sure that we understand how everything works. And what I like to do is I like to break the market into phases. Right? I'm a big believer in what we call universal price. Now, universal price means simply this. All charts are the same. All patterns repeat themselves. The shortest time frame always has to resolve itself into the longer time frame. Okay? Again, all patterns repeat. All charts are the same. Because, again, what is a chart? I mean, here you're showing some of what we look at here, and you're just a candle or a bar, whatever you're using is your charting method. You know, if you use open, high, low, close bars, or if you use candles, or you just use straight lines, every mark is a moment in time, whether it be a minute, whether it be a day, a month, it does not matter. The focus is that the patterns themselves will repeat within all time frames. And that's what we're looking at. So what we look at first is we look at markets and we look for what we call consolidation, right? Because all markets are born in consolidation. I'm going to share with you right now, real quick, my screen. Okay, and you're now seeing my screen here, and now we talk about consolidation. So when we see consolidation is what we'd call the time of most uncertainty in the markets, and certainly, oops, excuse me, all right, I gotta get my line back. But the uncertainty of the markets is when the markets are going up and down within a range. All right, and what happens when you do that is what forms the market in consolidation. That is when the market's making a series of double tops and double bottoms. What's happening here is buyers come in and buy and push the market higher. Sellers come in and they form a double top, and the strong hands keep rotating between buyers and sellers because new money keeps pushing around. That is, again, the biggest time of mass confusion is when the markets are in consolidation. Now, many people trade in that pattern. If it's wide enough, it's acceptable. But what we look for and what we're looking for is after consolidation, the market, and we'll call consolidation the birth of any market because all big trends, all markets start out of consolidation. After the market gets ready to break out, now breakout can be up or down, but in this particular chart, it happens to work out that it's starting to break up. So we're going to go ahead and show you the break up. So now we're breaking out and we get the uptrend. And of course, we do break out to the upside here. Right? So the breakout is the life of the markets, and that will continue, and they can continue for extended periods of time. And again, depending on the time frame you're looking at, you know, it'll be the number of bars or charts that you're looking at. But after the after the consolidation and after the breakout, most markets end in what we call a blow-off. And sure enough, look what we got going here. We have a blow-off in the markets at the end of the day, and this would be a blow-off to the top, to the upside here. Now, you know, what does this mean? It'd be something that we'll be looking for, and we'll work on this a little bit later, but this would be usually the end of that current cycle. Now, that does not mean that the markets are going to go down. What it means is that the markets will either go down or they'll probably consolidate and look for the next direction. But this particular bull run here for this cycle, which we're looking at a 4-minute chart, believe it or not, for now is over, right? And now we just look and go to a longer term chart. Okay. So now we're looking at a daily chart. And isn't that interesting? What do we have here? Oh, gee, look at that. We've got consolidation. All right. We've got the breakout, reconsolidation, and now look, we blew off on a daily chart as well. Basically, you've got the same pattern. One's on 4 minutes, one's on a daily. And I assure you that if I put it a monthly on, you'll get the same kind of view. You'll see a similar pattern as this loads up. Okay? But my point is that that's where we say all charts are the same, all patterns repeat, and the markets work in that general direction. All right? So that's what you want to focus on and watch. Here is, you can see a monthly. Geez, we have consolidation, almost identical. So they change as you change the market, as the patterns change. So we go back to a 1 minute. All right, we've got a market that consolidated and broke straight up. All right. So right now we'd have to say we're in an uptrend or in a blow-off pattern. If we go to a 10 minute, look what we have. We have consolidation and then a blow-off here. So again, the patterns continue to turn back and forth depending on the time frame that you're looking at. All right? And that's what you want to focus on. as you understand and learn to read the charts the way that they should be read for the type of patterns that we're going to use. Let me go back to, let's see, go back to my slides. All right. So we've got the three phases of the market: congestion, breakout to the trend, and blow off. Okay. Now, actually, we're going to stay on the charts here. So what we're looking for, all right, what we're looking to do is markets, and all markets do the same thing. Here's we're looking at the mini Dow. Here we're looking at crude oil. Oh, that's in a downtrend. But it doesn't really matter. The simple point is that the same patterns will appear, and you'll get the same action out of this. You look at gold today. Gold had a pretty big reversal late in the day. All right, now, notice how the patterns are the same. We've got consolidation up at the top. Okay, and you've got the breakout, you've got the downtrend going lower, and of course, then you get the blow off down here, which would indicate you might get a little bit of a bounce. So what we're doing is we're trying to take advantage of the markets and what goes on within the markets. Because if you can grab an edge by understanding the chart and the footprints that they leave, then you're getting an edge on everybody. Because does anybody know what causes these big moves in one direction or the other? Anybody want to comment on it? I mean, certainly I'm happy to hear your comments, because I'd like to hear what you're thinking, because understanding why this is happening is as important as anything else. Institutions, okay. Sentiment, okay. Covering, okay. You guys got it. Fear and greed, okay, you're getting it, yeah. All right, so these markets are driven, obviously, we're driven by emotion, right? Fear and greed drive the markets. That's always been the case. Now, right now, in the overall market, there's no fear. Does anybody disagree with that? Nobody's afraid. The markets go up every day, okay? At the end of the day, the markets go up right now every day. Nobody cares. Nobody's got any fear whatsoever, which is why volatility is falling, why the markets are dribbling higher, why there's no real price volatility anymore. Right? But when you get these unusual spikes, or when you get the actual blow-off, the blow-off is driven by either greed or fear. Now, this would be a blow-off to the downside. But what I want you to notice, as we look at the day, big volume spike, not much to do. Big volume spike, a little bit of a blow off to the downside, which actually rallied, consolidated, and then broke. But notice, this has to tie in with volume, okay? The overall trade ties together, all right? So what you're looking for is a panic move up or down that then ties with volume, right? If that happens and you take the other side of that trade, you are putting yourself in a favorable position. It's not a question of if you are definitely 100% putting yourself in a favorable position, because the traders and the people that are trading the other side of that market are either puking out or chasing the market up, okay? This happens more often than you think. It happens on a regular basis during the day, and I think it's something that everybody needs to learn, is to understand this particular pattern. And when you look at this pattern, all right, there's a couple of things that we tie together. We trade on multiple time frames. Right? We are looking for something to occur in the 4 minutes. Let's just put up the same chart. So I've got the Dow. Let's put the Dow up here. Okay. All right. So here's the Dow 4 minute, and here's the Dow 1 minute next to it. So now, as I look at this chart, all right, I can see the consolidation. So what I'm looking for is the blow-off pattern. Well, this could be considered a blow-off pattern, and of course, it blew off into what we would call a double top, actually, right, the top end of consolidation. But look at the high volume bar here compared to the bars before. Now, again, we can't look forward because we don't know these are in the future, but we can look behind, and this is what tells us that we're getting some extra action. And at the end of the day, if you see these happening, this is what you're looking to execute on. Now, what I'm really looking for first I want to identify the blow-off pattern, okay? And I want to identify that on my 4-minute chart. But the way that I enter this trade is I'm going to switch over to my 1-minute chart, right, to find out how I'm going to get in and where I'm going to get in. Because if it's going to continue to go up, for example, if we look at this end of the day, I don't know if the 1 minutes would have put us in yet, but we're going to know in a minute. But they may not have put us in till way up here, right? And that's what we're kind of looking for. So if I look at this particular pattern here, which is at just after 1400, all right, just get myself down a little bit. Okay, so just after 1400, all right. So here was the blow up to the upside. So right here, approximately, would have been our entry point on this potential short trade. All right. Now, that would have been somewhere around 22,718. Now, again, it was neither a big winner or a big loser. It would have been possibly a small winner. But in the meantime, it's not the size of the trade now. It's more the concept of what happens. But not only did it blow off on the 4-minute, but this is the 1 minute gave me the okay to say, okay, it's okay to sell it here. All right. Now, how do I know that? Well, again, that's when that's happening, and I had the Bollinger Bands on the 1 minute chart, because the Bollinger Bands will tell you from a mathematical standpoint. Remember, if we go back to the original, this is a game. So in all games that we can grab a mathematical edge, that's what we're trying to do. So if we understand, and if you understand the Bollinger Bands, which are basically a move of 2 standard deviations up or down. Now that you can adjust that, but the standard that John Bollinger wrote was 2 up or 2 down. Okay, and the middle bar is what they call the mean. Now these always change, and they look like, if you look at them right now, like, oh my God, I got in that trade those, I could make a fortune. Well, unfortunately, they move as the markets move, but the math doesn't change. And one thing you'll notice is you get wide bands and then the bands narrow. So you know one thing for sure: if the bands are narrowing, you are in a consolidation period. If the bands are widening, you're getting a breakout one way or the other, or possibly the blow-off. So what we look at here, and what makes this trade so appetizing, is not only do we have the blow-off on the 4-minute, not only do we get the 1 minute signal, but we got the math told us that we are 2 standard deviations above the mean, and most markets will revert back to the mean. Okay, most markets will revert back to the mean. Actually, I do it live for people that subscribe with me. I'm actually trading the jobs number live tomorrow morning, which I've done for the last 14 months. So yeah, I do. It is good live, and of course that's part of being with me. But at the end of the day, right, this is how it works, and we do this every Jobs Friday. I trade live for everybody because I've done this so long. But it's a great way to understand and learn. And before you can trade it, you've got to understand the overall basics of the market function and what's actually happening and the methods that you're going to use to get in. And again, this happens to be the Dow, but you could look at crude oil. This happens to be the Dow, but you could look at crude oil. We'll do crude on the same 2 time. At the end of the day, okay, as we look at crude, all right, off of this very heavy volume bar. Now, at the end of the day, that would have been one we would have looked at to potentially trade. And of course, if we go over to the bat cave to our 1 minute chart, and we're looking at the same 1330 time frame, right? We got the trigger right here, right? And of course, it did come down a little bit. Now, it wasn't a big winner, and that's one of the things you look at when you're trading, right? Is what is the actual price volatility? When charts are built to scale, the small moves look like the big moves because everything's scaled together. But when you can recognize the actual pattern, which is again what we're looking for, because the overall numbers are always the same. It doesn't matter. And that's the focus. And so the way that you can use this part-time and do it, and what I like to teach it as is you got an hour to kill, you got 2 hours to go, whatever. I mean, I don't want anybody sitting in front of the machine all day. Again, it's not really that much beneficial anymore. And I think you're better off, you come in when you're ready, and I don't want to worry about what happened yesterday or what's happening this morning. All I care about is what does the chart tell me right now. So if I want to come in and trade right now, if I would have traded this product from, let's say 12 to 1, right, I would have got a trade out of it. Now, there's not always going to be a trade. If I came in at 2, there's no trade, basically, okay? So that's the key, is you got to be able to say, okay, I'm not going to trade. I didn't get the pattern. I didn't get what I was looking for. I'm going to sit by and watch, right? Because there's going to be days that are going to be very active, and there's days that are going to be very slow. Now, one of the objectives we like to get to is having multiple charts. Like for myself, example, I have 32 charts up at once, right? And I don't have them up full blown like this. I just have them up because what happens is you see when the markets start to flash, you see something's going on, you can just pull up an individual chart. But our goal is to get a number of different charts up at one time. And I'd say for the average person, 4 to 6 is a good deal. And you can then have opportunities, because the key to this method is the number of opportunities you can create for yourself. The more trades you can find, okay, the more money you can make. It's a numbers game, and of course, if the pattern is correct, and we're gonna hit it. Now again, there's losers here as well. This is also, again, probability. It's like pocket rockets. Not every trade is going to be a winner. Right now, we've been tracking, and we're averaging on basis on one contract of the mini Dow, an average loss of $80 or so, and an average gain of about 150 to 160. All right. Now again, we feel that we can hit over 50%, and that gives us a nice profit going forward. But again, there's no guarantee on results. But there is one thing that we know: if you follow the rules, then we know exactly what our losses are on every trade. Again, we have a direct formula that says this is your stop loss. And in the Dow future, okay, let's go back to the Dow, because I think this is important for everyone to understand. If I'm trading the Dow, all right, and let's say I did do this pattern here, and my stop, let's say I get it now. Obviously, I didn't sell the top, because you never get the top. So let's say I sold, let's say the top was 22,720. So let's say I got in at 22,714. Right? Well, that's 6 ticks, but I'm take 6 ticks and add it to the top. So my stop automatically, the minute I enter, my stop automatically goes in at 6 ticks above the high of the blow off. That's where my stop comes in. So in this particular trade, it would have been about 12 ticks. That's $60. Now, how much do I make? Well, that's really hard to say. I mean, here we might not have made anything on this trade, although it looks like it could have been a winner. You'd have to have been one heck of a manager to make anything on this trade. But what you might have been able to do is the second rule we like to do once we set the stop is, if we get a move that covers what our risk was going to be, whether it be 10 ticks, 8 ticks, 50, 60, whatever it is, once we get a move to that point, we then want to move our stop to break even. Because then we want to use the phases of the market to help us manage that trade, because the longer we can stay in this trade, the more success we're going to have. Right? Now again, we can't. It's not always by choice. Sometimes we just get out because it does what it's supposed to do. We make a little bit of money, and the pattern changed, so we take our money and we run, or we take our loss and we run. But there are times that you can get in and look for great opportunities, and we focus on all of these things. Okay, it's always about what we're trying to do and what we're looking for, and we go back to the repetition of all charts are the same, and that's simply a key factor in how we do this. Is we put ourselves in the position to be on top of the game, right? And when we look at different charts, and if we go to just for example, if you wanted to get a general idea of what we look like longer term, okay, you'd break the same thing down. You'd look at the pattern where we're at, and of course, here we are in a monthly chart, or daily, that is blowing off to the upside. Right? Now again, we would not sell this on this pattern. We would look for a shorter time frame. If you were somebody who wanted to trade longer term, You would simply look to say, okay, so let's say I want to sell, I want to get short here. All right, so how am I going to get short? So I'd have to go to I'd go to a longer time frame. If I was going to use a daily, I might use an hourly to back it up. All right, and so on an hourly, we have not had a downtick yet. So there would be no reason for me to get short here yet. Very important to understand the footprint. The footprint is not allowing you and telling you that you should not be getting short here. Okay, this is how it all works. You don't want to. You don't want to. You don't want to jump in front of the market. Right? You don't want to jump on that falling knife. You want to let the markets do what they do. And if you subscribe to what I just said, where the markets always repeat themselves, and it takes the shortest time frame, then of course until the hourly turns, we know the daily can't turn before the hourly. That's why you use the secondary time frame or the shorter time frame. The overall model itself is designed to create what we talked about, universal price. Somebody asked what the best indicators to use. As I just look up at the chat, indicators are up to you. I use zero myself, but I do teach the Bollinger Bands for futures day trading. I think that's important. It does help guide you because there are some trades that are close that may or may not be exactly what you're looking for. But of course, I urge you to always try to make that trade. And the Bollinger Bands give you a good idea of what's going on. And of course, if I throw, if I believe in the math, which I do, then it gives you that kind of an opportunity. Right? And so, but I mean, my only recommendation is whatever you use, don't use too many. Don't put yourself in an asylum because you're getting analysis paralysis or paralysis by analysis, whatever they call it, because again, it'll drive you crazy. And again, the indicators are just that. They're an indicator to try to help you and give you a hand. They're not an absolute. All right. They can't trade for you. You still have to be able to make the decision. So let's go back and look at some rules to live by. In this type of trading, it's in every type, but especially here, you have to be disciplined. You cannot chase the markets up and down. You are waiting for one specific pattern to appear here, all right? And that's it. And if you try to outsmart it, you'll usually outsmart yourself. And again, the mistakes that I talk about are ones I've made myself. These are all built off of me. After 38 years, I've made a few. Okay, your largest drawdown is always in the future, and it's something that again you just have to be prepared. And if you take care of your business, you put yourself in a position to press up when you're winning and cut down when you're losing. We want to grow our account organically by making winning trades. We want to get to bigger size, but of course, if we go back into a drawdown, we want to start to reduce. It's always an ebb and flow of trying to build that equity curve that you're building. And the simple facts are the markets will reward you if you take the time to be patient enough to let them. Most don't have the patience to let it happen. All right? Most want to be opinionated about what's going to happen in the market. All right? The markets can remain irrational for far longer than you can remain solvent. Now, if anybody could have told me that this market wouldn't go down and we'd be at these levels right now, I'd have told them they were crazy. In fact, I've told them they were crazy a couple of times on TV, but it shows you that the markets can go higher and there's nothing to stop them, just like when they're going lower. Right now, nothing changes the market's opinion. The news doesn't bother it. Good news, the markets explode higher. Bad news, they sit for a minute and then they go higher. And this will change like it always does. And when it changes, we want to be ready. And that's by using these tools, you can be ready. Now, the time frame is important as well. The shorter the time frame you want to trade, the more trades you can create. In my eyes, the more trades you create, the more money you can make. But again, it comes down to, so I don't think you'd want to go less than 4 and 1, but that basically gives you 15 bars an hour. So there's opportunities at 15 times an hour. And again, there's going to be times that nothing's going to happen, and you'll have to sit there and watch it. You have to go through, all these markets and watch all right, as things change. It's just the nature of the business. Again, it happens on a regular basis, and if you manage your risks successfully, the rest will take care of itself. This is a competition. Okay. If you don't have the competitive edge, don't compete. All right. Again, I might sound a little stern, but that's, again, there ain't nobody handing out free lunches nor $100 bills. It's up to you to take them. And you can do that by following the different methods and by mainly being focused on your discipline and what you're trying to do, all right, and what we're trying to have you do. I think this is something that is always available to you. And of course, if we go back and look, right, at some of the charts, I was on to look at the Russell, because again, everybody says, well, the market's going up, but they're all going up. Well, not necessarily. Just because one market's going up doesn't mean they're all going to go up. Now, the Russell was pretty much in a downtrend today, right? Even though it's higher in the day, but look at the action. All right, this is again what your views are, and that's why we don't care. See, I don't care what the long-term trend is. All I care about is what happens in that 4-minute span. All right, this is what we're focusing on a regular basis. It's right now, what's happening right now. All right, which is why if you happen to be sitting at home and it's 8 o'clock at night, you happen to be looking at your computer and the market starts to move, if there's enough volume and liquidity, you can fire away. All right, again, it doesn't matter when, because we know one thing for sure. We know what our risk is going to be. We don't know what our reward is going to be, but we always know the risk. There should never be a question in your mind of how much you're risking any one trade. So to grind it out and keep making those trades over and over again, and again, then if we get to that point, then the more we can make, okay, the more trades we can make, the more opportunities we have to make money. Again, we know life comes down to two things. One of them is money, right? So we all want to learn better ways to do it. And as you learn these skills, this will also make the rest of your trading better, because everything that I'm sharing with you is the same no matter what time frame you're looking at. It's just the longer the time frame, the longer you have to wait. And that's what makes the difference. If you can speed up time, you can speed up the opportunity to make money. Right? And then if you can add the numbers of charts and look at more than one chart at a time, then you bring yourself another opportunity. And that's kind of like tomorrow morning, I will trade gold. I'll trade the products that are most affected by the announcement, the jobs number. Gold, bonds, euro currency, and the Dow. Now, I would trade more, but I'm teaching at the same time I'm trading, so I don't like to give away. I got to focus on something. But normally I would trade them all. If I wasn't talking, I would trade all the equity products, all the interest rates products, and gold, silver, and oil. But because I'm doing it for a group, I want to be very careful. I do not have a live trading futures room. I'm not. I don't typically like to do that. Again, I believe in letting everybody fish for themselves. I teach you how to fish. I guess that's what I'm trying to say. I'd rather you do it on your own. And if you're trying to do it through a room, you give up a lot of liquidity, especially when you're trying to bang out small profits. I'm just not a fan myself personally. Nothing against it, but that's kind of my deal. I'm a big believer in learning it on your own, and that's kind of what we look for. But you saw something today interesting in the euro currency. Look what happened here. We had the blow off to the upside, and look what happened. Fell out of bed. All right, this was a great trade. I actually made that trade, so I can talk about that. I can talk about this one for sure. I made this one. Right. But again, that's what we're looking for is opportunities as they come. So if we look at the day, look what's happening. So we're seeing a number of different patterns that are applying up, and look what happened at the end of the day. Boom, up to the moon. All right, so that would be, if we were trading this long term, we might look at it as be a seller here. But again, these are things that we focus on and look at all the time. I think that it's of the utmost importance for all of you to understand the discipline and what it takes to handle all this. And I think that what you want to look for is the ability to do things. Now, we do a couple of different things, and one of the things that I do is I have a couple of different webinars a week that talk about charts, talk about charting and trading, and we also do. I've got a futures service that people can I give you the picks for long term or day. We have day trades and what we call swing trading or spec trading. All right. That's one thing that we offer, and that comes with a daily update. It comes with texting alerts if we're going to change something. But typically there are orders that I put in that I don't want to affect anybody's liquidity by trying to trade them too tight. So there are orders that we put in, and typically we'll work them for the entire day, or we'll work them over time. We've done extremely well with the service, and again, there's no long-term contract. We usually do get $99 a month. We're doing it for Ninja. We're doing it for $79 a month now, and you get them both, but not everybody wants to trade longer term, because remember, if you're trading longer term, it means you need more margin, right? If you can, the day trade you can trade with a $5,000 account. The swing trade you need more, and it's very important that you understand. Again, that we've done very well, and the track record's available on request. But again, I don't want to go on the past results. I want you to see what goes on in the future. And again, there is no long-term commitment, so you can certainly check that out. I don't mind tick charts. Actually, I think tick charts are fine. I think at night you would use tick charts. All right. I don't have an issue with anything of that matter. I've used them both. I think tick charts are great, but again, when it's busy, I don't need to use tick charts. But I'm in agreement with you. I think it's a good thing. But again, to me, tick charts are better when the market's a little quieter, because it takes longer to build the bar. All right, and then I have a Monday night strategy call, which is more to chart reading and more to individual stocks and options, although I do cover all the futures as well for a longer term trade. And we do that every Monday night at 6 o'clock Eastern. That call is available to you. It's normally $149. It's available to you for $119. I'll give you my thoughts on gold, sure. And you can get that at BubbaTrading.com Monday call. Again, really a great call. Not that I want to toot myself on the back, but we do a great job at educating and giving you the general right idea of what we think is going on within the overall markets. And of course, we've done some really great trades, in time there. But again, it's really educational, and it gives me a chance to discuss the news, which I don't really care. I don't really care about the news personally, even though I do the news, even though I'm a commentator, I don't really care. And I never bring the news up when I'm on air. I talk about what the market's going to do. I don't care about anything else. All right. And I think that's something that we all need to recognize, is that by the time you and I hear the news, it's already too late. It's gone. Okay. And I think that's something that we tend to get ourselves caught up on. Do you prefer time charts over tick charts? I did that one. Who gives the best margins? Ninja gives the best margins. My thoughts on the gold trend? I think gold's going higher, actually. 1262 is my number long term. I write for Kitco every day. I'm a buyer at 1262. We were buyers at 1200, 1204, and I thought it was. I think the bear market is over, but it looks like it's a little bit of a challenge. I think it's getting a little bit challenged from Bitcoin, to be honest with you. Okay, and then we have available to you the day trading class. It's a part-time class, all right, we do 6 one-hour webinars of teaching, and the beauty of those is once you become a member of those classes, you can repeat them for free anytime you want, and we work on the trading the futures, all these things that we've talked about today plus more, to put you in a position of success. And that's always our objective, is to help you organically grow your portfolio. And the last thing that we offer, okay, is I guess I duplicated that slide. Sorry. It's the part-time trade course is normally $1,500. We're offering it for $1,200 today. What's a good stop loss on crude oil? On what time frame? Okay. Give me a time frame. I'll tell you what I would do as the best stop loss. 5 minutes. Well, I would use. I mean, I don't use them. I wouldn't just trade crude. If I got in, let's do this. I'll give you this example. Okay. If I just sold crude here, all right, on the way down, my stop would have been about 12 or 14 ticks above the top. So let's say at 51. I actually did get stopped out in crude today myself for a small loser. But I would have used the top of the bar I'm entering on, or the bottom, depending if I'm buying or selling, and then give it 12 or 14 ticks from there. You know, in the Dow, we give it 6 ticks above or below. In crude, a little bit more volatile. You got to go a little bit wider. And of course, the Dow will change as well. All markets will change as we get more volatility. You know, this market is reminding me of 2004, when the average trading range in the S&P was about $3. You know, it was like impossible. And that's basically what we have right now, even though it's, you know, you'd see 1,200. Well, 1,200 really, if you look at a percentage basis, is nothing. Okay. You know, I started trading when the Dow was under 1,000. So, you know, the numbers are the numbers. But we do the day trading course, which is normally $1,500. For Ninja's people, it's $1,200. And other than that, you know, if there's any questions, I'll be happy to answer all your questions. Do I ever look at the overnight high and low? No. Again, this pattern, okay, what we're doing here, now I look at it myself because I do some longer term trading as well. I mean, I do a number of different types of trading, right? But for this particular pattern, none of that is valuable for that pattern. For what I'm teaching you today, or what I showed you today, none of that means anything, okay? The value is in the panic that we're taking advantage of. The panic is at the time when we're trading. We don't care. We're not, again, I don't want to get involved with what may happen with news. I'm giving you something that's a mathematical probability model versus what's happening. Again, do I understand what that? Sure. Do I look at markets? Yeah, I look at charts on a long-term basis always. All right, that's what I do on Mondays. I look at the overall, but when this particular method has no meaning to what the overall news or markets are going to do. It means one thing: you're trying to take advantage of the people that are puking. All right, or if you remember Billy Ray Valentine, I'm feeling the panicking out there. I feel it. They're panicking. Right? That's what we're trying to take advantage of. Okay, and the views come down to very simple. All right, put yourself in the best spot, create an opportunity, and make the trade. But while you're making the trade, remember, when you get in an airplane, what's the first thing the pilot tells you? How to get out. Where's the exit door? The minute we get into a trade, we set the stop to get out. All right? It's not subject to negotiation. We don't want to put ourselves in a position of not. So you always go with the contrarian. Let's see. Is the Bollinger Band trading part of the day trade course? Yeah, it is. Okay, it's something I teach. I'm going to give everybody the best opportunity to succeed. Okay, and I've got a really high track record. I got a great number of success stories. But I want to give you every chance, and that's something that helps you. Again, I don't use it myself anymore, but it's a great guide. It's kind of like, you know, when you're an artist, you start trying to stay within the lines, and then once you get a little freelance, you get outside the lines. What if panic selling turn out more panic? That'll happen, but you'll get stopped out, and you might have to re-enter. Right? Again, that's the beauty of what we're doing. We know that we're risking $80 on a trade. Right? Look, I'll tell you straight up. I did jobs. I don't remember which one it was, but we had to make. I don't know, 6 or 7 trades to make money. Right? You know, again, that's why we use a fairly narrow stop based on what's going on. But again, there's always a bounce. I will say that there's always an opportunity. But if you're not getting the short-term time frame to turn for you, this is where you're missing the point. If you don't get the short-term time frame to turn, then you're not getting it anyways. If I get the classic signal to sell these, well, if this is still going up, I'm not selling yet, right? The 1 minute chart will tell me when it looks like it's starting to turn. Now that doesn't guarantee that I'm going to be right on that particular trade. I might have to make it once or twice or 3 times. But what will happen is I will be prepared, and I know that it can't go. If I'm selling it, it can't go lower until the short term turns over. If I'm buying it, can't go higher until the short term starts to turn up. So you always go with the market, no contrarian trading. No, I'm contrarian. We're actually in this particular model, we're countering the market. Okay, if they're puking them to the bottom, we're buyers. If they're blowing them up to the top, we're sellers. We're definitely contrarian on this particular pattern. We do trade the DAX, yeah. I've got a couple. In fact, in one of my classes, I show one of my clients wrote in and says it works in German too. How do you tell the difference for what instrument goes slightly above a breakout? Well, again, we're not playing the breakout here. We're playing the puke or the greed. How do I know? I know because as the volume ties in, okay, I know that the pattern is getting ready to change because what's happening is the buyers or sellers are exhausting themselves. Now, many times the blow-off will create a quick move in one direction. We might make our profit and it may turn back and go the other way. But some of the times you get what we call the V, which is the great reversal, which we had one the other day. On Wednesday in the NASDAQ, we had one, and it was a $500 winner. Before you could even open your eyes, it had dropped 30 ticks. All right, and that sometimes will happen. Now, it doesn't happen often, but you're prepared for it. Right? But you don't. Again, we know if I assumed this and made a mistake and got in on this bar, I'd have got stopped out because of where it went. But then I would have gotten again. All right, it comes down to recognizing the whole trade, right, and recognizing what we're trying to do. So if you use the discipline that goes along with it, then you're in good shape. If you don't use the discipline, then you're just going to lose money. I mean, that's what it comes down to. You're trying to outguess the market, you'll lose. Do you see the ATR stop your stop? No, our stop is based on number. The Dow, we use 6 ticks, above or below. I'm not looking for any average true range. I don't use all that. It's straight math, easy numbers. All right. It's 1 + 1 is 2. We don't want to get complicated. I don't want all these indicators to look at. I know I give you specific numbers based on the market conditions, and because I'm constantly emailing everybody and constantly teaching this, if it changes, I literally know that the dynamics have changed a little bit, but you can kind of see it yourself. As we get more volatility, then the model will change a little bit, but the patterns won't change, but the amount of risk we will have to take will. All right. But again, the amount of profit we will make will also change, and that's the biggest thing to remember. Even though you think that volatile markets are tougher, volatile markets are the best. Volatility is a great forgiver in life, unlike these begrudging, tight, hardly moving markets, even though they're drilling higher. How do you feel about crude oil? You think we see 45? Actually, I think we see 40. That's my call. I stand by it. I was there when I got 42, and I did cover some and resold it, but I didn't cover it all. I am short crude, and I'm looking for 40. And eventually I'm looking for 19 again. I mean, that's a long time away, and I don't like to talk like that. But eventually, I think crude goes back to where it was way long time ago. Profit to loss ratio. No, we can't really make it a ratio profit loss because I don't know how far it's going to move. I know what my loss is always going to be, and right now the loss is about 16 tick average, which is $80. Right, the average profit is about 160. All right, but I can't guarantee any of that. That I can only guarantee what I'm going to set my stop at. All right, that's the only number I can for sure guarantee. I don't know what this is going to do when it does it. That's why, we had a trade the other day, as I said, it was a $500 winner in 2 minutes. But of course, sometimes they're not, and that's where we've learned to manage. That's part of the class. See, what happens is we will manage the trade. And just for example, all right, real quickly, if we got into this trade here, or you're looking at you're not looking at my screen. Okay, hold on. Here, let me just show you this real quick. So if you're looking at this chart here, okay, if I got in here, right, and we started to break, right, and here, boom, 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 we're going my way, I'm happy, and all of a sudden, for whatever reason, the market stopped going down, and it started to go sideways. So consolidation right away is a warning sign that, hey, maybe I should be, looking to cover, all right, or at least adjusting my stop. And of course, in this case, it would have worked. I would have adjusted. I wouldn't have made a lot of money, but I would have been able to get out. But I would have recognized the market was starting to move my way, okay, or against me, rather. That's what you're looking at. Would you mind sharing an example of a trade recommendation you have made in your speculation trade? Sure. Today, we recommended selling the S&P at 2. What was the number? 25.38. We got stopped out at 25.41. So we lost money today. We sold the bond futures at 158. We covered at 153 for a $5,000 winner. We took on the day trades, our typical trades. We've traded hogs, we traded cattle, we traded everything. Crude oil. We've had never huge losers. Again, we very much manage the amount of risk, but we right now in our spec part of it, we're short. We're long cattle. We're long soybeans. We're short the Russell, which is actually profitable, believe it or not. And I think that's all we have on right now. To think about it. But again, we continue to be more conservative in the markets that are extremely challenging. I don't put positions on this to put them on. There'll be days I won't give out a trade. Okay, I'm not interested in creating a lot of trades if there's not anything to do. I'm not going to put a trade on just to put a trade on. The only trades I put on are the ones I actually put on myself as well. What's a good stop loss for ZB? Again, if you're talking about long term, is one price. If you're talking about the model, it's another price. I would say that on average, right now, I wouldn't be a seller now. I am short, but I'm looking to cover because I'm expecting a dead cat bounce here pretty quick. But in the bonds, usually I'll give about a half a point, like 16 ticks, $500. If I'm holding it longer term, I might go more. Sometimes I won't put a stop in on a longer term trade. I'm willing to take what it's going to give me, and I'm not afraid of what's going to happen. Okay, so again, there's just certain things that, I use stops more for people that are with me than for myself. I don't always use stops myself because I'm willing to hold certain things because I have a pretty good idea what they're going to do. And sometimes they squeeze you up pretty good before you get there. A 2-minute chart on bonds, I don't know. I wouldn't give it more than 3 or 4 ticks. Bonds have become really a strange animal over the years. They used to be the tightest product. You couldn't move them. You had to trade thousands to make any money. And now they all of a sudden became the most volatile product on the floor. Interesting change in dynamics. But you got to be very tight in that because the moves are just too fast and too big. You get trapped too fast there if you're on the wrong side. This morning, I traded bonds this morning with actually a 4-tick stop. And of course, I got in and they broke down. I moved my stop down. And of course, they took me out and of course, they broke. But, I made money. I'm not complaining. How many contracts on average for me or in general? I don't understand your question. How many contracts on average? For me, I'll trade 5 to 10 of any of them at one time. Sometimes more, sometimes a little bit less. Depends on it depends on how active we are. And it depends on my overall conviction. If I'm trading, intraday on our scale, on the blow-up pattern, I'll trade 5 to 10. Are your patterns ABC up or down trade, or we only trade the blow-off pattern for this model? Okay, is it ABC? I don't know. It's strictly price and volume. When they exceed normal, we're taking the other side of that trade. It's just like when the markets were panicking down a couple of months ago, and everybody was nervous. I just wrote a letter to everybody in the morning. I said, look, don't panic, don't do anything. Let the markets open and then look to buy. All right. The same thing I said in 1987. All right. When the market was crashing and everybody was crying, I said, just go and buy it. You got to buy them here. And not that we're going to be right. We're going to go straight up. But again, panic on either side will typically lead to a move in the other direction, even if it's for a short period of time. So before you ever do anything, before you ever panic, give it some thought before you do anything. All right. Well, I appreciate everybody's time. Unless there's any more questions, I thank you for spending your afternoon with me. It's always enjoyable, and certainly don't forget Bubba at BubbaTrading.com. You can get, if you want to take a look at the track record. If you want to join my class, certainly you can go to the website and let me know. But the 3 things that we offered today were the day trading offer, which is BubbaTrading.com/day trade. The Monday night call is BubbaTrading.com/Monday night call or Monday call. And the monthly service of my recommendations, bubbatrading.com/spec trades. And again, a pretty simple entry. You $79. You can go for every month. And of course, one thing about my company, once the rate's in, that rate will never change for you. So anyways, I appreciate you all.
This is Ryan coming back from the NinjaTrader ecosystem, and I'd like to give a special thank you to Todd Horwitz of Bubba Trading for his great presentation this afternoon. The NinjaTrader ecosystem is pleased to sponsor our weekly vendor events as a value-added service for all of our clients. So if you find value in these events, we would hope that you would attend them on a regular basis. And we'd like to remind everybody in the room that the information provided in this presentation was that of Bubba Trading and not that of the NinjaTrader Group. All information presented was for educational purposes and should not be construed as trading advice. If you have any interest in joining a NinjaTrader training event throughout the week, we have our platform training schedule at the following link. And again, we appreciate the time that you spend with us in these webinars. We hope you enjoy the rest of your day and hope to see you in our future webinars. And happy trading from all of us here at NinjaTrader.